Welcome to the Kaiser Report. I'm Max Kaiser. It's a bonfire of misallocated capital. Stacy!
Is that slinky for something?
Yeah, it's going to be misallocated capital. We're going to play with this concept, I have a feeling. This is the go-to analogy.
I thought you were just trying to add some color to this gray background.
There's no adding color to this gray background. Not with David Cameron as Prime Minister. It's a permanent cloud of doom.
I think London's in mourning for David Bowie. So it could also be in mourning for the markets, of course. We're going to start with this tweet here. After 4 trading days, the S&P 500 is down 4.9%. This is the worst start in history, going back to 1928.
Boop. Boop. See, it fits all occasions. Boop.
Is that the S&P decline?
This is the S&P kerfuffle. Oh my goodness. This is China. This is Brazil. Oh, here's the Russian ruble, not looking too good. What's this? Oh my God, here's NASDAQ. Oh dear. Oh, here's the S&P 500. Oh Lord, it's a total catastrophe, knuckleheads.
The South African rand is not looking good either. That's
new all-time low against gold.
Yes, yes, yes. And the S&P is down 6.6% since the Fed raised rates. There's bizarrely a whole group of trolls who believe that the Fed interest rate rise of 25 basis points has not caused any impact at all. Bizarrely, these are weird deniers.
You mean you can't taper a Ponzi scheme? You can't taper a Ponzi scheme? You can't taper a Ponzi scheme? That's right. They raised rates and markets pooped the bed immediately because it's a Ponzi scheme and you can't taper a Ponzi scheme.
Well, there's a whole contingent of Fed deniers out there, or interest rate deniers.
They're ideologues. They're ideologues. They believe Janet Yellen is God and that everything she says is worth killing themselves and others for. They are the jihadis of Wall Street.
And then there's another tweet here. China PPI continues to drop 5.2% in 2015, marking high deflationary pressure of economy. And here's the little photo that goes with it. I thought it was pretty amazing. It really looks like you're
It looks
slinky.
like a vortex.
It looks like you're slinky,
It
and
is.
it looks like a deflationary collapse. So if you show that slinky going straight towards the camera,
there's a little man in there.
It could look like a deflationary collapse.
There's a little man in there. Look at that. It's like, here's the guy. He's in some kind of meta slinky. Here's the Max slinky. Oh my God, we're going to have to work on that.
And then here's another chart to start off 2016. I think you might find it quite exciting. This is the market cap right over here of Saudi Aramco.
Huh.
Here is Exxon. Here is BP, Lukoil. And as you see, the market cap of Saudi Aramco, if it were to go public, would be dwarf all of the other oil giants, and it really puts into context the whole global oil market. But the Saudis claim, there are some people there that are claiming that they might go public with Saudi Aramco.
Yeah, if Saudi Aramco went public, it would be 3 times bigger than the GDP of Great Britain. To put that into perspective, it's, it would come out at $5 to $6 trillion. Apple Computer is at 600 billion, 650 billion or so. ExxonMobil is at around 350 billion. Mm-hmm. So, but the question is, who would have the money in a descending market to put $5 to $6 trillion into this Saudi Sunni Wahhabi catastrophe, unless they want to go, ooh, I lost all my money.
Well, there are some who are celebrating it, actually, and they're calling it Margaret Thatcher-like, reforms to the economy. And I want to point to this headline here and a paragraph from this article that is quite interesting to put it into the context of what this could spiral out of control in Saudi Arabia. Prince Mohammed bin Salman, naive, arrogant Saudi prince, is playing with fire. German intelligence memo shows the threat from the kingdom's headstrong defense minister. So Saudi defense minister and deputy crown prince Mohammed bin Salman, he's the powerful 29-year-old favorite son of the current king Salman, who has dementia. So his son is apparently controlling a lot of things, including this idea of floating Saudi Aramco. And he suggests austerity and market reforms in the kingdom, but in the context of Middle East autocracies, and particularly oil states, this breaches an unspoken social contract with the general population. People may not have political liberty, but they get a share in oil revenues through government jobs and subsidized fuel, food, housing, and other benefits. Greater privatization and supposed reliance on the market with no accountability or fair legal system means a license to plunder by those with political power. So you could see this is the beginning of the disintegration of the Saudi royal family. There's a lot of there's a lot of fighting between the thousands of princes of who's going to have power, and if they float this now, the guy can take his huge share, and obviously London's going to take all his money, and they don't mind recycling it for him in the property market here. But it could be the spiraling down of Saudi Arabia.
Well, how else are you going to monetize beheadings? Here's a way to monetize beheadings. Okay, Saudi Arabia, they're doing dozens and dozens of beheadings. You want to get in on the beheadings racket? So you can buy into Saudi Aramco. For every beheading that they do, the price of Saudi Aramco could be up 1% or 2%. So if you want to cash in on the beheading market, certainly participate in the Saudi Aramco deal. It's fantastic.
Well, speaking of license to plunder, this is another article, and this is a headline from Bloomberg News. Remarkable, JPMorgan HSBC seen among banks likely to win Aramco IPO. JPMorgan Chase and HSBC are among international lenders in the best position to win a role if the kingdom goes ahead with the IPO of Saudi Arabian oil or Aramco. People familiar with the matter said the two banks, whose presence in the kingdom goes back decades, helped arrange a $10 billion loan for the company last year. So here's the two most recidivist banks in the UK, HSBC, and in the US, JPMorgan, who have been fined over. 2015 was a year of record fines, or was that 2014 for JPMorgan? HSBC fined for all the beheadings and the Mexican drug cartels and laundering their money. So the fact that they're now going to participate in this, what some could say, looting Saudi Arabia, is interesting.
Right, it's a great triad of psychopaths, isn't it? HSBC, who was with the Mexican Sinaloa cartel, and they killed 60,000 Mexicans, a lot through beheading. JP Morgan and Jamie Dimon, who was caught, as you say, recidivist.
A recidivist.
The recidivist, yes. That means that they do the same thing over and over and over and over and over again. They commit the same crime over and over again, and they're never penalized. Then you got Saudi Aramco. So you've got the biggest money laundering, the biggest beheader, and the biggest financial terrorists to coming together in one holy trinity of the Father, the Son, and the Holy Beheader, all together in one joyous stock offering. As I've said many times before, these guys would have taken Auschwitz public to monetize in on the death camps if they had that opportunity. That's the mentality we're dealing with.
So again, a big shakeup in the oil markets. The price is now free floating. It's not being able to be rigged because anytime it goes above $60, $70, the U.S. frackers could come on and blah, blah, blah. So here's another story that has happened in the January of 2016, and that is the notion that Russia is floating the idea of having their own oil market and price index. So it would be priced in rubles, however. And you tweeted, and I'm not just like talking about you, but I'm talking about Jim Rickards' response to you. So you said, I think Jim Rickards predicted this, another reason Russia is stockpiling gold. Jim Rickards responded to your idea that this is somehow a big seismic change by Russia having a ruble index for oil. He said, thanks, Max. I forecasted the ruble as a regional reserve currency for use with the Russian periphery. This is a start. So again, big shakeup coming in the oil markets in 2016, 2017 is something to look forward to.
De-dollarization.
Yes.
De-dollarization. So Russia and China realize that they're financing America's wars by supporting U.S. dollar as a world reserve currency, which is tied to the most actively traded commodity in the world, oil. So Russia, working with China, come up with their own oil price index and futures contracts tied to that index based in rubles. Then you move away from the dollar to get de-dollarization, so that Russia is tired of spending money cleaning up America's messes. So they have to clean up America's mess in Syria. They have to clean up America's mess in Iraq. They have to clean up America's mess in Afghanistan. They're thinking, you know what, how can we save money? Well, America's spending dollars that we pay tribute to because they've got the world reserve currency. Let's just de-dollarize the world and we save money. We don't have to clean up after America and Cameron's messes.
Well, I think it's also the fact of just having two eyes looking around and seeing the world. I think it's an inevitable thing that if an empire collapses, the de-dollarization has to happen. The debts have exploded since the global dollar standard. It's only been happening since 1971 that we've been on a global dollar standard, and we're at peak debt, and that is the dollar. It's debt. That's it. So there has to come something new after that.
Well, I think Germany would also be interested in de-dollarization, given the immigration crisis. 1 million now in Germany. Merkel's freaking out. They've got huge social unrest. Why? Because they're now asked to clean up America's messes. In Syria, in Iraq, in Afghanistan.
Here's a tweet from Paradigm Shift, also talking about the financial markets and the collapse of many big companies. Apple shares are tumbling, Amazon, all these big internet stocks. Paradigm Shift says by the time the investigation into the next global financial crisis ends, subprime unicorns will be a commonly used household phrase. I like that. So, this notion of that in this 0% interest rate world, before the Fed raised the rates, the Fed created these massive global bubbles. Again, some of it was in fracking, some of it has been in housing, and no housing market bubble has been bigger than London and San Francisco. And we have all these money chasing anything, and they've chased unicorns. I think your slinky would be a good point.
Well, in 1980s had accumulation, then 1987 crash, distribution. Then post-1987 crash, you had accumulation until the bond crash of 1994, distribution. Then you had accumulation until the dot-com crash of 2000, and you had distribution. Then you had accumulation until the subprime crash of 2007, then you had distribution. Then you had accumulation until the current crisis now, which is unfolding. Is it the China blow-up? Is it a sovereign debt crisis? Is it going to be the Saudi Aramco spring that topples the regime? You have distribution. But we're clearly now in a period of distribution. After a period of accumulation, we're in distribution. That means lower prices, distribution. What are the tools available to the central banks to bail out the banks this time? Well, they've already gone down to 0% interest rates. Do they have more, as they're doing in Japan, actually going into people's private accounts and buying their stocks from them and giving them yen? Well, we'll see if they resort to that. But nevertheless, we're into a de-dollarization of the global financial schema. That's the theme, Stacey.
Well, if you go to America and you see people believing in unicorns and throwing around slinkies and being like, we have an economy here. We have an economy here.
No, they're just going to keep legalizing pot smoking in America so people don't understand that they're being completely shafted and having their economy pulled out from underneath them. But they'll be high and they'll be enjoying life from the perspective of drug use.
That might be a better thing.
All right, well, we got to go to the second half. Thank you. All right, stay tuned for the second half. A whole lot more. Welcome back to the Kaiser Report. I'm Max Kaiser. Time now to turn to Lee Adler. He's the publisher of the Wall Street Examiner. Lee, welcome to the Kaiser Report.
Thank you. Nice to be here.
Been following your work for years, so it's great to have you on the show. And I would say you're a Wall Street expert, Wall Street historian, very level-headed, look at prices and blow away a lot of the hysteria and smoke and
Absolutely.
give kind of a reasoned, in-depth look at things. And so I wanted to have you on because now we're at the first week of trading, and we've had the worst first week of trading in history on the markets, various markets. What's going on? What do you see here?
Well, it's all part of a process, Max, a process that began in 2014 when the market began to top out. And contrary to the conventional wisdom, market tops are never a surprise. They go through a period of 12 to 15 months where there's distribution and the markets go up and down in a range and everyone stays bullish on Wall Street. And
Did you see my demonstration with the slinky earlier? I had
No, but that would
distribution and
be a
accumulation.
that would be a
Distribution,
perfect-
accumulation.
That would be a perfect description of it.
So
And,
you agree with me then? That we're in a period of distribution
absolutely.
now.
I love analogies like that.
Yeah, it was 7 years.
I think we're beyond the distribution now. The smart money has left the building. And now it's up to the Wall Street shills to keep everybody else in place so that they can continue to unload their large long positions and build their short positions. So
Let's talk about that for a second because it's a very important point. There's really two markets out there. There are the professionals and then there's the amateurs. And the amateurs don't really know what the professionals are doing a lot of times. So you're saying corporate insiders have been unloading stocks.
There's actually one market, and it's a market that's run by the market makers, the primary dealers. Now, of course, if you go on the
Who are they're the 18,
the 22.
22.
Yeah, but actually, there's 13 worldwide major banks that are correspondents to both the Fed, the ECB, and the Bank of Japan, and of course the Bank of England, which is smaller, less important, but it's important here.
Meaningless. Mark Carney,
absolutely,
meaningless.
Absolutely. So these 13 of the largest banks, led of course by Goldman Sachs, correspond with all of the world's major central banks. So they're pumping cash while they're doing QE into the same 13 banks, and those 13 banks are trading the same markets. And the biggest and the most favored market of theirs, of course, is the U.S. stock market and the U.S. Treasury market. And that's where they funnel their cash that's coming in from all of the central banks around.
Okay, let's focus on this a little bit, because you mentioned these primary dealers and how they fit into the architecture of global markets. Because people are familiar with the central banks, and they're familiar with people going on TV and talking about the central banks, Janet Yellen and Mark Carney or Mario Draghi, but very rarely do you hear about this middle layer, which are the primary dealers. In other words, when the central banks decide that they have a policy initiative, they're going to make money either more or less available. They're going to either make credit more or less available. The way they do that, the machinations, if you will, are by dealing with these 13 global institutions, the primary dealers. I guess there's 22 in total.
There's 22 in the U.S., and only 7 of them are U.S. banks. I forget the exact breakdown.
No, that can't be right. You're saying there's 22 overall in the world.
Right.
And there's
22 primary
center. There's 13, I guess, of the more liquid
the
type.
Largest. The largest ones are, a few of them are Goldman Sachs and JPMorgan and Bank of America Merrill Lynch. But then you also have your HSBCs and your Barclays and your Nomura's, and these guys trade with everybody. They're the ones that decide where the money is going to go. The Fed and the ECB, they, like you said, they make the money available, and they do it directly. There's only one conduit for monetary policy to be transmitted to the markets in the economy, and that conduit is via the primary dealers. So the cash comes into them, they decide where it's going. They decide what's going to happen. Now, of course, they're in the business of marking up prices, because that's what they do. They take in wholesale, sell retail. So they look for the market where they're going to get the most love, and it's always the stock market, because they have this massive media machine that is manipulating the public into taking their inventory at a higher price all the time. But the Fed sent a signal in October of 2014 when it said, okay, we're going to stop QE, and then they started talking about raising interest rates, and that sent a signal to the smart money. Well, all of that free, low-cost, zero-cost lending that they did was basically used for one purpose, and that's carry trades. And when the Fed sent the signal that we're going to end that game, the smart money started to unwind. So you saw gold break in 2011, then you saw oil break and all the commodities, and then it spread into the emerging markets, and now finally it's spreading into the last Ponzi game standing, which is the U.S. stock market.
Okay. You brought up another term there that we've talked about on the show a few times. Let's dig into it some more, carry trade. Okay, we've been talking about this idea for years now, and basically it's arbitrage. In other words, you could say it's interest rate arbitrage, but the way we talk about it, an arbitrage is being buying and selling in two markets simultaneously when the prices are different.
Yeah, I don't use the term exactly correctly. I think I use it to refer.
Well, we're digging into it now, Lee. That's why we're talking about it, okay? That's what I'm supposed to be doing. That's my job. So let me just go down this path, okay?
I'm sorry.
So we're talking about the carry trade, and we started talking about it a few years ago, and it's related to the Swiss franc and the Japanese yen, because you could borrow at, it's Japanese yen being a good example. The interest rates are 0.000001. You can borrow at this almost 0%. And then you can take the money you're borrowing, and you can invest it in, let's say, U.S. Treasury that might be paying 0.5% or 1% in a bond. You're making the difference between your cost of funds, which are 0, and that 1% you're getting in a U.S. Treasury bond. You're making 1%, and you're not taking any risk.
Correct.
Essentially, well, you are taking some risk, but if you're a professional, like on a bank on Wall Street or in the City of London, you can hedge that risk in derivatives markets, in futures markets, and options markets, so that you're essentially, you can create a positive carry trade with no risk. And that's what we mean in some instances of a carry trade. But what you're saying in this instance is that when the central banks give this money available to the primary dealers then have this money and they can use it in this almost risk-free way to create these carry trades for them, because they're interested in that themselves. Their self-interest is not the interest of
absolutely not
of free market capitalism.
When they go on CNBC to tell you what to do with your money, they're not giving you advice in your interest. They're trying to manipulate you. It's a marketing game. They're manipulating you to help them to dispose of their positions or accumulate their positions. They're not, and mostly they're interested in disposing at higher prices. So, they tell you to keep buying all the time so that they can sell to you.
Right, so they have like a storekeeper, and you mentioned this phrase inventory, like a store has an inventory of porridge, and they want to get rid of their porridge.
Exactly.
So these primary dealers have an inventory of money that they just got from the central banks that they paid nothing for.
It's a wholesale to retail game. Exactly.
Now, the financial press is quite shockingly irresponsible because they tend to be cheerleaders, and they make this what I call market fundamentalism or financial jihadism, where prices going up is the godlike,
right?
And prices going down is the devil,
exactly.
Right? But that makes no sense. It's like saying red lights are better than green lights. Green, you need both to have a flowing traffic. But they loved, like James Cramer on CNBC. He's a cheerleader for losing money. Essentially, if you did everything James Cramer said to do over the years, you'd have been bankrupt many times over again. Because he's a cheerleader for fraud.
Right. We don't know. I mean, maybe it's just laziness on their part, but let's face it. Who's paying the bills for these networks and for these big media companies? They're essentially in the game of don't rock the boat and let's keep the boss happy. I mean, that's where their revenue comes from.
Well, NBC, is NBC.
Right.
NBC was owned by General Electric at some point. At one point, I don't know if they still own it. But then General Electric, of course, has GE Finance, which they're financing with the war machine, and they do so by borrowing money from the central banks at 0% interest rate.
Yeah, when you turn on CNBC, they're not talking to you in your interest. They're talking to you in the interest of their clients, which are the big banks that pay the bills there.
Okay, let me ask you this then. Russia has come out and said we want to de-dollarize because we're tired of paying for America's wars. We're tired of financing America's exceptionalism as they go around the world and kill people and create a migrant crisis around the world. So they're going to create an oil index. They're going to have people trading in rubles, and they want to take the dollar as world reserve currency out of play. Is that feasible in your view? Have you looked at that? What are your thoughts?
Yeah, I'm not a currency expert by any stretch of the imagination, but I don't see the dollar going away anytime soon. I mean, I'm a technical analyst first and foremost, so I'm following the trends on the charts, and then I'm a monetary analyst second, or maybe both of them equally. And I think as long as the Fed is not printing and the world's other major central banks are printing, there are going to be less dollars around, so to speak, than there are of these other currencies. So the dollar trades relative to other currencies. The ruble, I think, is, I don't know what percentage of the world, I mean, it's an infinitesimal.
It's about 1% of Forex or less.
Yeah, I mean, that's probably a very long-term play. And I don't believe in looking much more than 6 months over the horizon because the longer out you look, the more unpredictable it becomes. That's adverse to the conventional wisdom. But I think once you look beyond 6 months, it gets pretty cloudy out there. I think the long-term trend is not heading in the right direction. But as long as, relatively speaking, the U.S. is creating less dollars and there's this immense demand for dollars to pay off these carry trades.
Okay, well, I'll take that message with me to Moscow when we're doing our shows there in a week or so. We'll be in the Kremlin, right on the Kremlin Square, doing our TV show there. And we'll take this message from you and try to communicate to them.
I think their strategic horizon's a little longer than mine.
Well, be that as it may. So let's get back into what you're saying here. The dollar is decelerating in its use case, and this is causing what we saw in 2008, which is deflation in a lot of ways. Markets are freezing up. There's a credit freeze. If the rates are going up, there's a credit freeze.
Yeah, we're seeing deflation, of course, in the commodities and in the emerging markets. We're seeing deflation in financial assets. The issue of deflation and inflation when it comes to consumer prices is something else altogether. So
there's a confusion around that.
There is a lot of confusion.
We can talk about that.
inflation.
If you can stay with us for another segment, we can talk about that
Sure.
in the second segment. But I just want to finish up in the minute we have here. We were talking a lot about this oil. Let's just do a minute, and then we'll have you for a second segment. But can you comment? I don't know if you've looked at this or not, but Saudi Aramco is thinking about doing like a $5 to $6 trillion initial public offering.
Yeah.
Thoughts?
Well, yeah, that'll take cash out of the market. When any large entity issues stock, well, for example, the biggest entity issuing paper every week is the U.S. Treasury. So whenever they do that, that requires cash. So if the world's central banks are not producing enough cash, if Saudi Aramco comes with an offering of that size, it's going to depress the market.
Well, didn't they miss the window? I mean, if they did this 3 years ago.
Their timing is just impeccable.
Impeccable meaning horrible.
Horrible, exactly. Yeah, I was being facetious.
Yeah. All right. Well, we're going to stay for a second half. We'll talk about that and some other stuff. So don't go away.
All right.
That's going to do it for this episode of the Kaiser Report with me, Max Kaiser, and Stacey Herbert. I'd like to thank our guest, Lee Adler of the Wall Street Examiner, who will stick around for another segment in our following episode to follow up on some of these key issues. Now, if you'd like to get in touch with us, you can tweet us at Kaiser Report. Until next time, bye, y'all.